Welcome back to the deep dive. Ready to dive into some serious stock trading wisdom?
Always ready. And looks like we've got a great guide for this one, too.
Oh yeah, we're cracking open Mark Minervini's Think and Trade like a champion this time. Should be good.
I've been wanting to dig into this one. Minervini's not just about what works. He really gets into the why, you know,
Mm-hmm.
the thinking behind it all.
And it seems like you're looking for some seriously concrete advice on leveling up your stock game, right? Well, Minervini doesn't mess around. Right off the bat, he's like, listen, success in trading, not luck. It's a choice.
Bold statement. Kind of flies in the face of what a lot of people think about trading, huh? Like it's all just gambling.
Right. But he backs it up too. Talks about how back in 1990, he decided, like a conscious decision, I'm going to become a champion investor. And the crazy thing is, his results, they match the talk.
Makes you think maybe it is I choice if he can do it.
Exactly. Inspiring, right. And he doesn't just tell you what to do, which so many of these books do. He lays out the how and the why. Breaks down the whole psychology of winning. I've always found that fascinating, how your mind plays into it all.
Oh, for sure. It's half the battle, at least. Maybe more.
Okay, so let's get into some of Minervini's principles. Right out of the gate, he's like, you need a detailed trading plan, like no ifs, ands, or buts.
He even talks about how back when he was starting out, he was just winging it, making impulsive trades.
Yeah, and it sounds like those early days, well, let's just say it wasn't pretty.
Not pretty at all. And, what's interesting is he doesn't just mean like a plan for picking stocks. He's talking about every single aspect of your trading.
So, like, what kind of stuff are we talking about here? What are the key elements?
Well, he says, first off, you got to have a crystal clear entry mechanism. You have to know, without a doubt, exactly when and how you're going to buy a stock.
That makes sense, I guess, but I feel like most people are probably just jumping in when it feels right.
Then there's risk management, of course. Super important. Got to know how much you're willing to lose on any given trade. And even more importantly, what you're going to do if things go south. Which they will, sometimes.
Yeah, have your exit strategy figured out before you even get in. Smart.
And you need a profit-taking strategy, too. When are you cashing out? It's not about holding forever. It's about knowing when to take those wins.
It's all about timing. Right.
Then you've got position sizing. How much are you putting into each trade? Can't forget about that.
And what about like moving your money around? Reallocation.
Yep. And rules for that, too. When do you move from one trade to another? Got to have a system.
So it's like all these things come together. They make this roadmap for your trading, right?
Exactly. And that's what's so crucial, especially if you're ever feeling a bit lost in the market, which, let's be honest, we all do sometimes. Minervini's approach takes away the guesswork.
Yeah, it's like he gives you these clear, actionable steps. No more just throwing darts at a board and hoping for the best.
Speaking of not throwing darts, one of the coolest things he talks about is this idea of holding tennis balls, selling eggs.
That's such a great analogy, right? So vivid.
Super memorable. He's basically saying, think of good, strong stocks like tennis balls. Yeah, they might bounce around a little bit, but they're resilient. They always bounce back.
But then those weak stocks, those are the eggs. Drop them once, they're done. Cracked. No coming back from that.
Yep, shattered. And the key is knowing how to spot the difference. Right.
Okay, but how do you actually DO that? I mean, I get the analogy, but...
It comes down to research. Got to understand the company, its fundamentals, its growth potential. Are they built to last?
I feel like the mistake so many people make is holding on to those eggs for too long, hoping they'll magically turn into tennis balls.
All the time. And that's why I love that analogy so much. It helps you make those tough calls, when to hold them, when to fold them.
And to just walk away.
Exactly. Avoid getting emotionally attached, which is always a danger.
Speaking of practical tips, Minervini talks a lot about the 20-day moving average, right? I feel like a lot of traders use that, but he really emphasizes it, especially after a stock breaks out.
Yeah, it's not just about looking at it by itself. It's how the stock's behaving around that line that tells the story.
So, like, what are you looking for exactly?
Well, if a stock closes below that 20-day moving average after a breakout, that's a red flag. It could be a sign of trouble brewing.
So it's a heads up, like, hey, pay attention, something might be changing here.
Exactly. Catch those warning signs early. And then there's another red flag he points out. I really like this one. It's low volume out, high volume in.
Okay, for those of us who aren't chart experts, what does that even mean?
Basically, it means a stock pops on low volume, which could mean buyers aren't really convinced. But then, when the stock dips, the volume spikes. More people selling than buying. Bad sign.
So a stock going up on low volume, that's not always a good thing.
Nope. Could be a fake out, a trap, Some people trying to dump their stock and catch others off guard.
Whoa, that's sneaky.
It is. That's why watching the volume is so important.
Yeah.
It tells you what's really going on beneath the surface.
Okay, so we've got some red flags to watch out for. But what if a stock stumbles after a breakout? Is it always a goner?
Not necessarily. Minervini talks about this idea of a reversal recovery,
Okay, now I'm picturing a boxer getting knocked down and then,
getting back up.
yeah, like shakes it off, comes back to win the fight.
Exactly. That's the reversal recovery. Stock takes a hit, but then regains momentum, keeps climbing.
So sometimes you gotta have a little faith. Give it time to recover.
You give some good examples, too. Biodelivery Sciences International, Micron Technologies, both stumbled after breakouts, then went on to make big gains.
Patience, young Padawan. Patience.
But the trick is knowing the difference between a temporary stumble and a full-on breakdown. That's where your plan, your risk management, knowing how to read the charts, all that comes in.
Wow, I'm already getting a lot out of this, and we're just scratching the surface. But before we go deeper into the technical stuff, I kind of want to talk about the emotional side of trading. The mental game.
Yes. The mind of a trader. Definitely a key factor that Minervini doesn't shy away from. He actually talks a lot about the psychology of trading, which is great.
He talks about this thing called the paralysis regret cycle. I feel like everyone's been there at some point, right?
Oh, totally. That feeling of being stuck, can't make a decision, and then later kicking yourself for not doing anything.
It's like that internal battle. Do I buy? Do I sell? Wait, what do I do? And then no matter what you choose, you're like, ugh, should have done the other thing.
Mentally exhausting. Just drains you.
So how do we break free from that cycle? What's the secret?
Well, this is where having a structured approach, like Minervini's, really helps. When you have a clear plan, with your entry and exit points all figured out, it takes the emotion out of those decisions.
Makes sense. Less second guessing, more clear-headed thinking.
Exactly. Instead of reacting to every little market wiggle, you're operating from a place of confidence, knowing you've got a system.
I like that. Less stress, more strategy.
And to really drive this point home, he tells this funny story about his childhood, riding a bucking bronco.
Oh, yeah. Black Orchid. What a name, right?
Classic. He basically compares jumping on that crazy horse with zero training to picking super volatile stocks without a solid plan. Both kind of asking for trouble.
Yeah, a wild ride that might not end so well.
The takeaway is choose your stocks carefully, pick your battles. Don't just jump on the riskiest thing out there hoping for a thrill.
Because that thrill can turn into a nasty spill real quick. So let's say you've got your plan, you're choosing your stocks strategically. What's next on the path to becoming a champion trader?
Well, Minervini says it's crucial to understand your trading batting average. Might sound a little weird, baseball and stocks, but it's a powerful concept.
Okay, so what's he talking about here? What's a batting average in trading?
Simply put, it's the percentage of your trades that are winners. Important because it helps you figure out how much risk you can handle.
Oh, I see. Like if you're winning more often, you can afford to take bigger swings.
Exactly. It's a numbers game. You don't have to win every time, but you need a system that gives you an edge over the long run.
And this kind of leads into another key thing he talks about, result-based assumption, or RBA.
This is where things get serious. Separates the pros from the amateurs for sure.
Okay, I'm ready. Lay it on me. What's RBA all about?
It's basing your risk on your actual track record, not on what you hope will happen. Brutal honesty with yourself.
So no more, this trade is going to be huge E, gotta bet the farm. More like, okay, I win about 60% of the time, gotta adjust my risk accordingly.
Exactly. Look at the data, be realistic. No more living in fantasy land.
So this is how you avoid getting blinded by those rose-colored glasses.
Exactly. Data-driven decisions. That's what Minervini's all about. He actually compares stock trading to poker.
Interesting. How so?
Professional poker players, they make calculated bets based on the odds, the probabilities. They don't chase guarantees.
It's all about playing the percentages, like you said earlier.
Yep. Make the decisions that give you the best chance of winning over time, even if you know you're not going to win every hand, or every trade in this case.
So you're saying consistency is key?
Definitely. And that brings us to what Minervini calls the secret weapon of champion traders.
Okay, now you've got me curious. What's this secret weapon? Some super secret algorithm, a crystal ball.
Nope. It's way simpler than that, and often overlooked. Ready for it. It's tracking and analyzing your data.
Wait, seriously, that's it? Just keeping good records?
I know, sounds almost too easy. But the thing is, Minervini says most traders don't really know their own performance. They don't track their wins and losses, their average gains and losses, their risk, holding periods, all that.
Makes sense, I guess. If you don't know what's working, how can you get better?
Exactly. And he uses this great analogy to make it even clearer. The trading triangle. Compares it to photography.
Okay, now I'm really intrigued. Tell me more about this trading triangle.
So, like a photographer adjusts their ISO, aperture, shutter speed, to get the perfect shot, a trader needs to understand how their batting average, average gain loss, and risk all work together.
So it's all connected.
Big time.
Yep.
And when you track your data, you start to see those connections, those patterns, like how changing your risk affects your win rate, how your average gain or loss affects your overall profits.
So it's almost like a diagnostic tool.
That's a great way to put it. Use the data to understand your trading, then tweak things to get better results.
Data-driven improvement. I like it.
It's what separates the champions from the rest. Knowing your numbers, understanding your strengths and
Yeah,
weaknesses.
more flying blind.
Exactly. It's like having this feedback loop, always adjusting based on what the data is telling you. Kind of like how those elite athletes use all those fancy analytics to get better.
Oh yeah, great point. Constantly tweaking and refining. And speaking of optimization, let's talk about compounding. This is something Minervini's really passionate about, and for good reason. It's like the secret sauce of investing.
He's got this saying, compound money, not mistakes.
No.
So simple, but it really hits home. He's basically saying, forget those big risky bets, the home runs. Focus on those consistent, smaller wins.
So it's like instead of swinging for the fences and striking out all the time, you're just trying to get on base.
Yeah, get those base hits, rack up those gains over time. It's like that snowball effect. Each little flake of snow doesn't seem like much, but roll it down a hill and it just keeps getting bigger and bigger.
Until it's this massive force.
Exactly. That's compounding in action. Those small gains building on each other, leading to some pretty incredible results over time.
Minervini actually talks about how he shifted his focus to smaller, more frequent profits. And the numbers are pretty convincing. Shows you don't have to take those crazy risks to make serious money.
It's all about consistency, discipline, the long game.
Right, playing the long game. But even with the best plan, we all slip up sometimes, right?
Yeah.
It's tempting to break the rules, especially when you see what looks like a can't-miss opportunity.
Oh, I know. Those just this once moments, like you're telling yourself, it's okay, I can bend the rules this time.
And then you end up regretting it later.
Minervini's got this great analogy for that, comparing it to an alcoholic taking just one drink. So powerful. It's about how rewarding bad behavior, even once in a while, can really mess things up.
Because it reinforces those bad habits.
Exactly. It's like you're telling your brain, hey, it's fine to break the rules sometimes as long as the potential reward is juicy enough. Dangerous thinking.
Yeah, you're unraveling all that progress you made.
Like having a cheat day every day on your diet. Doesn't work. Discipline isn't about being perfect. It's about making the right choices most of the time, even when it's hard.
Staying the course.
And that definitely includes avoiding another classic trader trap, averaging down on losers. So tempting to try and buy the dip and make up for those losses.
Yeah, trying to get back to even. It's like a gambler trying to win back their money at the roulette table.
Minervini actually quotes Paul Tudor Jones on this one, who said, losers average losers. Kind of brutal, but true.
Yeah, it doesn't pull any punches, does he? But I see his point.
If a stock's going down and you keep buying more, you're just throwing good money after bad.
Makes sense. Cut your losses before they get out of control.
Exactly. And Minervini actually gives a really clear example of how averaging down can actually make things worse. Imagine buying a stock at $100. It drops to $90. You think, okay, got to buy the dip. But then it drops to $80. You buy more. Now you're stuck with a ton of stock that's tanking.
Sinking ship.
And that's why stop-loss orders are so crucial. Protect your capital.
Know when to fold them. Speaking of knowing when to fold them, another trap Minervini talks about is getting lured in by those cheap stocks.
The cheap trap. I've fallen for this one myself. You see a stock down 50, 60, even 70%. You think you're getting this amazing deal.
Too good to be true. Usually is.
Often there's a good reason why that stock's so cheap. Hidden problems, earnings are tanking, something's wrong.
The market's usually pretty good at sniffing those things out.
Right. Minervini says the market's a discounting mechanism. Those low prices might actually be reflecting future trouble. It's like buying a used car way below market value. Probably something wrong with it.
If it seems too good to be true.
Right. Do your research. Make sure that bargain is actually a bargain. And speaking of things that seem too good to be true, Minervini talks about this concept called differential disclosure. A little more complex, but really important for traders to understand.
Okay, break it down for me. What is differential disclosure? Why should I care?
It's the idea that big institutional investors, they sometimes have access to information that us regular folks don't. Not exactly a fair fight.
So they're playing with a stacked deck, basically. We're trying to play the game without all the cards.
Pretty much. And the frustrating thing is, you might not even realize it's happening. A stock drops suddenly, and you have no idea why. But behind the scenes, those big players might be selling based on info you don't have.
Sounds a bit shady.
It can be. That's why awareness is key. Knowing this happens helps you make smarter decisions.
So if you see something fishy, a sudden move that doesn't make sense, maybe step back. Wait for more info.
Exactly. Don't just blindly follow the crowd. Do your own digging, understand the company, and be careful with those sudden price swings that come out of nowhere.
Okay, good advice. So we've talked about some traps to avoid. Let's flip it around. What about strategies for actually making more money? Minervini is a big fan of scaling up on profits. What's that all about?
Great strategy. It's using your wins to fuel even bigger wins. Take the profits from a winning trade, increase your position size in your next trade.
So you're riding that momentum wave.
Exactly.
Oh.
Adding fuel to the fire.
Yeah.
And I know you're thinking, doesn't this go against the whole don't put all your eggs in one basket thing?
Well, yeah, a little bit. Diversification and all that.
Right, but Minervini says spreading your money too thin can actually limit your gains. He's more about having a concentrated portfolio, focusing on a few really strong picks.
So it's about going all in on your best ideas.
Yep. And there's some real advantages to that. First off, you can really get to know those companies inside and out. More research, more understanding, better decisions.
Like becoming an expert on a specific sport instead of trying to follow everything at once.
Exactly. That deep knowledge lets you make confident, decisive moves.
Okay, so you've done your research, you've got your top picks, you're scaling up on those wins. What about selling? When do you know it's time to cash out?
This is where Minervini talks about selling into strength. He says the best time to sell is when a stock's on the rise, not when it's peaking.
So take those profits while they're there. Don't get greedy.
Exactly. Ride that upward trend, but don't wait for it to fizzle out. And to help with this, he uses a really cool technique called base counting.
Base counting, like card counting in blackjack.
Not exactly the same, but similar idea. It's a way to figure out where a stock is in its price cycle. Kind of like reading a stock's biography, using its past to predict its future.
I like that. So you're looking for patterns, trying to anticipate where the stock's headed.
Exactly. And he talks about different stages in a stock cycle, each with its own characteristics and potential for growth.
So is it just getting started or is it about to hit a wall? Base counting can help you figure that out.
Right. And that knowledge helps you decide when to buy, how much to buy, and of course, when to sell.
So let's say you've got a stock that's looking good, it's on the move. How do you know when it's time to sell? Just pick a random price target.
There's more to it than that. Minervini says sometimes the stock gets a little too excited and leads to what he calls a climax top.
Climax top. Sounds kind of intense.
It can be.
Yeah.
It often means the end of a stock's upward run. It's like this sudden accelerated surge, almost like it's going straight up.
Like it's sprinting toward the finish line.
Exactly. But just like a sprinter can't keep that pace forever, a stock can't just keep going up like that. Eventually it burns out, and that's when the reversal comes.
And often that's driven by institutional selling, right? Those big investors taking your profits, heading for the exit.
Exactly. They see the momentum fading, and they're getting out before things go south.
So you don't want to be left holding the bag when everyone else is cashing out.
Nope. And Minervini gives some specific signs to watch for, potential reversal signals, like an increase in the number of down days compared to up days, or when you see the biggest up day with the widest price spread. Exhaustion gaps, too. All things to keep an eye on.
So these are warning signs that the party might be over soon.
Right. Also, watch for heavy volume on those down days and any big price drops from the start of that stage to advance he talks about. It's about being alert, spotting those signs before it's too late.
Don't get caught sleeping. So how do you protect those gains you've made?
Trailing stops. Super useful tool.
Trailing stops. What are those?
Basically a safety net that follows your stock as it goes up. As the price climbs, your stop loss order moves up too.
Smart. So if the stock suddenly drops, you're protected.
Exactly. You get to ride that winning wave, but with less risk.
Love it. And then there's the free roll, which sounds pretty amazing. What's that all about?
Free roll is when a stock's gone up so much that it's past your initial risk point. Now you can move your stop loss up to break even or even higher.
So you're basically playing with house money at that point.
Pretty much. Minimal risk, chance for some serious profits. But here's the thing. All these technical strategies we're talking about, They're only part of the equation. To really be a champion trader, you got to master the mental game. That's where Minervini brings in performance coach Jairek Robbins.
Yeah, the psychology of trading. So important, right? You can have all the technical skills in the world, but if your head's not in the game.
How it's all for nothing. Robbins talks a lot about staying emotionally detached from the outcome of your trades.
So you're not getting too high with the wins, too low with the losses.
Exactly. He uses this phrase, emotional force field, like a mental shield protecting you from the ups and downs of the market.
Cool concept. So how do we build this force field? What are some of the techniques?
He's big on positive routines, mental preparation, setting yourself up for success.
Create that structured environment.
Right. And he also talks about mental rehearsal, which is super interesting. He actually encourages traders to visualize both winning AD losing trades.
Wait, why would you want to visualize losing? Doesn't that just bring in negativity?
I know, it seems counterintuitive. But Robbins says by mentally rehearsing both outcomes, you build confidence and handle those emotional swings better.
So it's like practicing for those high-pressure situations, like an athlete visualizing both the perfect performance and those moments when things go wrong.
Exactly. Be prepared for anything, and those emotional reactions won't hit you so hard.
Yeah, like running those drills. Get comfortable with the discomfort.
Exactly. It's all about training your mind. And Robbins takes this idea a step further. He talks about shifting your focus from outcome to process.
So instead of worrying about whether a trade's going to be a winner or a loser, you're just focusing on sticking to your plan, executing it perfectly.
Yep. Detach from those emotional highs and lows. Focus on what you can actually control. Your actions, your decisions.
I can see how that would be helpful. If you're always freaking out about the outcome, you're going to be frozen.
Absolutely. That kind of emotional roller coaster is a recipe for bad trades.
So focus on the process, and it's almost like you're taking the emotion out of it, treating trading like a business.
That's a great way to put it. And this leads to another thing Robbins talks about a lot, the power of habits.
Which Minervini mentions too, right? Our habits, good or bad, they have a huge impact on our trading.
Huge. Robbins uses this framework, cue, routine, reward, helps you see those destructive patterns that can really sabotage you.
So it's those little things we do without even thinking, right? They can actually make or break our trading.
It's true. Like, are you constantly checking your portfolio, chasing every hot tip you hear, breaking your own rules? Those things become habits, and they usually lead to losses.
So how do we get rid of those bad habits and replace them with good ones? What's the secret?
First, you got to see them. Recognize those negative patterns. Understand how they're affecting your trading.
Take a step back, observe yourself like you're watching someone else.
Exactly. Then, once you know what those bad habits are, you can start to replace them with good ones, consciously. Build new routines that support your goals, set you up for success.
So it's like instead of impulsively buying a stock based on a random tweet, you take a breath, check your plan, make a rational decision.
Yep, rewire your brain. New inputs, new outputs.
This all circles back to that champion trader mindset we were talking about, right? Discipline, self-awareness, constantly learning, getting better.
Absolutely. And to help with this whole mindset shift, Robbins has this really cool concept, reprogramming the pain-pleasure cycle.
Okay, I got to hear more about this. Reprogramming sounds tense.
It's based on how our brains are wired, Seek pleasure, avoid pain. And for most traders, losses equal pain, wins equal pleasure. But Robbins says we can actually retrain our brains to respond differently.
So like not freaking out when you take a loss, but seeing it as a learning experience?
Exactly. And not getting too caught up in the wins either. Stay grounded, focused on the process. He even suggests celebrating small losses as victories.
Celebrate losses. How does that even work?
I know, sounds crazy, right? But it's about changing your brain's association with those setbacks. If you can train yourself to feel good about taking a small loss, it loses its power over you. No more fear and self-doubt spiraling into bigger mistakes.
It's like turning those losses into wins, in a way.
Exactly. You're building resilience, learning from your mistakes. And to support this whole transformation, Robbins talks about creating a supportive environment for success.
So it's not just about what's going on in your head, but also your physical surroundings, right?
Yep. He compares trading to training for the Olympics. Self-care, discipline, healthy lifestyle, it all matters.
So sleep, good food, exercise, all that good stuff.
All of it. Take care of your body and mind. They're your most important tools.
It's about that holistic approach. Trading, it's not just about charts and numbers, it's about your whole life.
Totally agree. And to help shift your thinking from negative to positive, Robbins talks about the power of asking empowering questions.
So instead of beating yourself up with, why am I so bad at this?
Hmm.
You're asking yourself questions that actually help you find solutions.
Exactly. Questions like, what can I learn from this? How can I get better? Focus on what you can do, not what you did wrong.
Turn those problems into possibilities.
And to deal with that fear of pulling the trigger, that hesitation a lot of traders feel, Robbins uses this great caveman analogy.
Caveman. Okay, I'm all ears.
He talks about how a caveman leaving his cave, spear in hand, he's not afraid, he's ready, confident.
Because he's prepared. Got his tools, got his plan.
Right. And Robbins says we can do the same. Use checklists, mentally rehearse those trades, really understand your system. That way, when it's time to make a move, you're not frozen by fear.
You're decisive, confident,
And finally, Robbins talks about how important it is to find the right mentor or coach.
someone who's been there, done that, can guide you, support you.
Someone who pushes you, believes in you, helps you reach your full potential. Because even with all the knowledge and tools out there, having that guidance can make all the difference.
So, wrapping up our deep dive into Think and Trade, like a champion, we've covered a lot, haven't we? The technical stuff, the risk management, the psychology of it all. It's more than just picking stocks, right?
Way more. It's a whole way of thinking, a way of being.
So now that you've got all this knowledge, what are you going to do with it? What's the first step you'll take to improve your trading?
Maybe it's finally creating that trading plan. Maybe it's diving deeper into your data. Or maybe it's working on that champion mindset. Whatever it is, start today.
Small steps, consistency, never stop learning.
Thanks for joining us on this deep dive.
Until next time, happy trading.